Why does your Florida sales tax return have lines for discretionary surtax and lawful deductions? And what does that even mean? Florida is actually one of the more straightforward Nexus states, but the return has a layer of county level tax baked right into it. And that's where sellers get tripped up. We've helped a lot of sellers get their Florida filings right. So today we're walking through the details so the whole picture makes sense. And let's start with the good news. Compared to a state like Texas, Florida's economic Nexus rules are relatively clean. The threshold is $100,000 in taxable sales into Florida in the previous calendar year. And there are a couple of things worth noting here. First, the measurement period is a calendar year. That's January through December, which greatly simplifies tracking. There's no rolling 12-month window to track monthly like in Texas. Second, there's no transaction count involved. It's purely dollar-based tracking. The other nuance is what counts toward that $100,000. Florida only wants taxable sales in the calculation. So if any of what you sell isn't subject to Florida sales tax for whatever reason, those sales don't move the needle toward the threshold. And when it comes to the grace period, Florida is generous. Once a seller crosses $100,000 in taxable Florida sales during a calendar year, registration isn't required until January 1st of the following year. Now here's where Florida gets interesting and where a lot of sellers get tripped up when they go to file. Florida has a state sales tax rate of 6%, and that part is simple. But most Florida counties also impose an additional local tax on top of that state rate. This is what the return calls the discretionary sales surtax. And before we continue, let's clear up that word discretionary. It means the counties have the discretion to impose it. It does not mean sellers have the discretion to pay it. If you're selling into a county that has a surtax, it's owed. The surtax ranges from 0 to 2.5% depending on the county. Florida is a destination-based state, which means the rate that applies is the rate of the county where the goods are delivered, not where the seller is located. So the same item could carry a different total tax rate depending on which Florida county it's being shipped to. What makes this particularly relevant at filing time is that the Florida return asks sellers to break out their sales by the surtax rate applied. It's not just one number for all Florida sales. The state wants to see the detail. How much was collected at which county rate, because the surtax ultimately flows to the counties. And one thing worth flagging for out-of-state sellers specifically, the rules for when and how surtax is collected differ slightly depending on whether the selling dealer is located inside Florida or outside of it. The FLDOR, or Florida Department of Revenue, has a clear table laying this out. Feel free to pause the video now if you want to review it. The Florida return also has a line called lawful deductions, and for a lot of sellers, that phrase raises an eyebrow. It sounds like there might be a long list of things to figure out, but for most online sellers, the primary thing that falls into this category is returned goods. If a customer returns a product and the sales tax was already collected and remitted, that overpayment can be deducted on a future return. Florida does define lawful deductions more broadly than just returns, and I'll flash the full list from the DR15 instructions on screen, but for a typical e-commerce business, returned merchandise is going to be the main component. Everything else on that list is either industry specific or situation specific enough that it's worth a conversation with a professional before claiming it. And here's the honest take on filing the Florida sales tax return. It is one of the more involved state filings out there. Between correctly allocating sales by county surtax rate, understanding the distinction between in-state and out-of-state seller rules, and making sure deductions are applied correctly, there are a lot of places where mistakes can happen quickly. For sellers who want to understand the mechanics fully, check out the Florida Department of Revenue's DR15 filing instructions for more detail. It's thorough, but everything you need is in there. But if you think the Florida counties are tricky, California takes it to an entirely different level of granularity. And for more on that, check out this video. And remember, when in doubt, always consult with a sales tax professional.